Let's get to 1,000 subscribers. Please help support Joni and our team by subscribing and turning on notifications.
Today, we've got some juicy stories to dive into. We're talking about the drama with NVIDIA and its troubles in China, the fading hope for a Fed interest rate cut, and a massive multi-billion-dollar deal between two tech giants. So grab your coffee and let's break down all this market chaos in a simple, fun way, just like we're chatting before the market opens.
JOYUP Invest Podcast. Invest better every day. Hello, dear listeners, and welcome to Wall Street Wake Up, the show that wraps up and updates you on what's been happening in the U.S. stock market and markets around the world over the past 24 hours. First up, a story that's been shaking up the tech market. The AI superstar NVIDIA paused production of its H20 chips for the huge Chinese market. Now, you might be thinking, why the sudden stop? It's a little complicated, but the short answer is it's all part of the trade war between the US and China. The US had previously restricted the sale of top-tier AI chips to China, but then gave NVIDIA permission to resume sales back in July. But just when things seemed to be getting better, China basically said, no thanks. It seems a US official made some comments that were seen as disrespectful about trading with China, specifically saying, we're not selling our best stuff. Ouch. That led to the suspension of H20 chip imports. So how should we, as investors, look at this? While this directly impacts NVIDIA, since China is a huge market for them, it could also be a catalyst. This pressure might push NVIDIA to develop even more diverse products for other markets. Or it could open the door for other companies to step in, leading to some exciting competition down the line. So even though it's a current challenge, it could lead to new opportunities in the long run.
Next, let's talk about interest rates. The market was once super optimistic that the U.S. Federal Reserve, or the Fed, would cut rates this September. But now, that hope is starting to disappear. Why is the optimism fading? The answer lies in the latest economic data. The Producer Price Index, PPI, for example, came in higher than expected. More importantly, two Fed officials recently said in unison, we're in no hurry to cut rates. They also pointed out that inflation is still well above their 2% target. It's still closer to 3% right now, and that there's still work to be done to bring it down. What does this mean for your portfolio? It tells us to be cautious. High interest rates increase costs for companies, but that's not always a bad thing. The fact that the Fed is keeping rates high means they still believe the overall economy is strong. We just need to be patient, wait for the right moment, and have faith in the long-term growth of the companies we invest in.
For our next story, let's move on to something a little lighter. President Donald Trump has signed an executive order to create a project called America by Design, aimed at modernizing federal government services. This might sound a little distant, but it's actually a big deal. The project wants to make government websites and systems more user-friendly and less complicated. Did you know that about 45% of US government websites aren't even mobile-friendly? This is all about improving the UI/UX, which will make it easier for people to use government services.
Now for a major deal that's making headlines. Meta, META, and Google, GOOGL, have inked a cloud deal worth over $10 billion. You might wonder why two companies that seem to be competitors would make such a big deal. Well, even though they compete in AI, using cloud services is like renting a huge server farm. Google has a very strong cloud infrastructure, and Meta needs massive processing power to develop its AI. This agreement is basically Google acting as the landlord, leasing space for Meta to work on its own AI projects. It's a smart way to leverage resources and shows just how intense the AI race is.
Let's start with Workday, WDAY. They reported earnings and revenue that beat analyst expectations, which is usually great news. But the stock price actually dropped after the announcement.
Then we have Intuit, INTU, which also beat on both earnings and revenue, but their stock dropped as well. Finally, there's Ross Stores, ROST. They beat on earnings, but missed on revenue, yet the stock price jumped.
See, earnings reports aren't just about good numbers. Sometimes good news doesn't make a stock price go up, and bad news doesn't always make it go down. It can be confusing, right? That's why it's so important to analyze what's happening behind the scenes. Now, let's wrap things up with a quick look at some interesting earnings reports and a bit of chart analysis. All the data we're talking about today comes courtesy of investing.com. And now for our daily stock analysis. I'm going to break down some of the individual stock prices we've been covering today in JOYUP Forecast. First up is Workday, WDAY. Looking at the chart, Workday has had a long-term uptrend, but for the past 2 years, the price has been moving sideways in a clear channel. It's been bouncing between $280 to $300 as a strong resistance level and a solid support level around $160 to $180. The price is currently right in the middle at about $227. Technical indicators like MACD and RSI aren't showing a clear direction, which just confirms that the market is thinking about where to go next. The price will likely stay in this range until it has a clear breakout or breakdown. A breakout above resistance would signal a strong return to an uptrend, but a breakdown below support means you should be cautious as it could signal a long-term reversal to a downtrend. Next, we have Intuit, INTU. This chart shows a strong, continuous uptrend. The steeply curving trend line tells us the stock has been consistently rising for a long time. Technical signals from MACD and RSI are still positive, even after a recent pullback, which is normal for a strong uptrend. A key support level is around $450 to $500. If the price pulls back to that level, there's a good chance of strong buying pressure returning. As for resistance, there's no clear level since the price keeps hitting new all-time highs. This means the price will likely continue to rise based on its momentum and the company's future growth.
Lastly, let's look at Ross Stores, ROST. This stock also has a clear long-term uptrend. The price has been climbing steadily since 2010, with only a few brief pullbacks before it recovered and resumed its uptrend. The price is currently at a multi-year high, and both the MACD and RSI still show strong upward momentum. The key support level for ROST is around $120, which is the long-term trendline support. Just like Intuit, there's no clear resistance level because the price continues to make new highs. The future direction of the price will likely be to continue climbing based on its built-up momentum and business potential.
All of this is just my personal view. It's not investment advice. Please use your own judgment and do thorough research before making a decision, because all investments have risks. Before we say goodbye today, if you're a stock trader and you have questions but don't know who to ask, feel free to leave a comment and we can chat. See you next time. Bye-bye.